Good afternoon, class. I'm going to discuss today key points in Chapter 21, Accounting for Leases. The learning objectives, number one, is explain the nature and economic substance and advantages of lease transactions. The leasing environment. A lease is a contractual agreement between a lessor and a lessee. The lease gives the lessee the right to use specific property owned by the lessor for a specific period of time. The largest group of leased equipment involves information technology equipment, transportation, trucks, aircraft, rail, construction, or agricultural. So who are the players? Banks, independents, and captive leasing companies. So in the banks, you have examples of Wells Fargo's, Chase, Citigroup, PNC, International Lease Finance Corp under independence, and then captive lease companies Caterpillar, Ford Motor Company, and IBM Global Financing. Captive lease companies are an auxiliary of a company that's already existing, like Ford would do their own leasing through Ford Motor Credit, and IBM would do the same through Global Financing. Independents share a very small portion of the market. Pretty much banks and captive leasing companies make up the market. Advantages of leasing for businesses: 100% financing at fixed rates, protection against obsolescence, flexibility, lease costs, less costly financing, tax advantages, and off-balance sheet financing. Some companies double dip on an international level too. The leasing rules for the lessors and the lessees countries may differ, permitting both parties to own the asset. Thus, both the lessor and the lessee receive tax benefits related to depreciation. Conceptual nature of a lease. Capital lease that transfers substantially all of the benefits and risks of property ownership, provided the lease is non-cancelable. Leases that do not transfer substantially all the benefits and risks of ownership are operating lease. Underlying concepts: the issue of how to report leases is classic case of substance versus form. Although the legal title does not technically pass in the lease transactions, the benefits from the use of the property do transfer. So accounting for leases, learning objective 2, describe the accounting for leases by lessees. The lessees capitalize a lease. The lessee's records an asset and a liability generally equal to the present value of the rental payments. They record depreciation on the leased asset and treats the lease payments as consisting of interest and principal. So here you have an illustration of journal entries for capitalized lease. For a capitalized lease, here the leased equipment is being put on the books as an asset, and then you have the lease liability. And then for the lessor, they're recognizing a receivable and the transfer of the asset off the books. For a capital lease, the FASB identified 4 criteria. The lessee transfers ownership of the property to the lessee. The lease contains a bargain purchase option. The lease term is equal to 75% or more of the estimated economic life of the leased property, or the present value of minimum lease payments, excluding executory costs, equals or exceeds 90% of the fair value of the leased property. So one or more must be met for the capital lease accounting. Here we have an illustration. Leases that do not meet any of the 4 criteria are accounted for as operating lease. So here you follow the steps with the lease agreement. You answer these questions, and the diagram kind of helps you determine whether or not it's going to be a capital or operating lease. So is there a transfer of ownership? Yes or no. So if it's no, move on. Is there a bargain purchase option? No. Is the lease term greater than 75% of the economic life? No. And is the present value of payments greater than 90% of the fair value? If it's no to all of these, then it's an operating lease. If it's yes to any of these items, then it's considered a capital lease. Capitalization criteria, transfer of ownership test. If a lessee transfers ownership of the asset to the lessee, it is a capital lease. Bargain purchase option test. At the inception of the lease, the difference between the option price and the expected fair market value must be large enough to make exercise of the option reasonably absurd. Economic life test, 75% test. Lease term is generally considered to be fixed, non-cancelable term of the lease. Bargain renewal option can extend this period. At the inception of the lease, the difference between the renewal rental and the expected fair rental must be great enough to make exercise of the option to renew reasonably assured. So here we have an illustration, accounting by the lease. Home Depot leases Dell's PCs for 2 years at a rental of $100 per month per computer, and substantially can lease them for $10 per month per computer for another 2 years. The lease clearly offers a bargain renewal option. The lease term is considered to be 4 years, the 2 years initially and then the 2 years additional. Here, capitalization criteria again, recovery of investment test, the 90% test. Minimum lease payments include the minimum rental payment, the guaranteed residual value, penalty for failure to renew or extend the lease, and the bargain purchase option. Your executory costs include insurance, maintenance, and taxes. They exclude from the present value of the minimum lease payment calculation. So discount rate, LESSEE computes the present value of the minimum lease payments using its incremental borrowing rate, with one exception. If the lessee knows the implicit interest rate computed by the lessor it is less than the lessee's incremental borrowing rate, then the lessee must use the lessor's rate. Asset and liability accounted for differently. An asset liability recorded at the lower of present value minimum lease payments, excluding executory costs or fair market value of the lease asset at the inception of the lease. Depreciation period. If a lessee transfers ownership, depreciate assets over the economic life of the asset. If the lessee does not transfer ownership, depreciate over the term of the lease. Effective interest method, used to allocate each lease payment between principal and interest. Depreciation concept, depreciation and the discharge of the obligation are independent accounting processes. So here we have Caterpillar Financial Services, a subsidiary of Caterpillar and Sterling Construction Corp. They signed a lease agreement dated January 1st, 2017 that calls for Caterpillar to lease a front-end loader to Sterling beginning January 1st, 2017. The terms and provisions of the lease agreement and other pertinent data are as follows. And here they're giving you the lease terms, executory costs, Sterling's incremental borrowing rate. Sterling depreciates on a straight line basis, and Caterpillar sets up an annual rental to earn a rate of return on the investment of 10% per year, and Sterling knows this fact. So what type of lease is this? So capitalization criteria, there's 4, and so it asks, does it transfer ownership? No. Bargain purchase option, there is no bargain purchase option included. Lease term is equal to 75% of economic life of the leased property. So the lease term is 5 years and the economic life is 5 years. So the answer is yes. The present value of minimum lease payment is equal to or greater than 90% of the fair market value of the property. The present value is $100,000. The fair market value is $100,000. So that answer is yes. So compute present value of minimum lease payments. So here we have a payment of $25,981.62. The property tax was given to us at $2,000. Minimum lease payment then is $23,981.62. Then calculating the present fair value factor using text with 10% over 5 years, the present value of minimum lease payments is $100,000. So Sterling uses Caterpillar's interest rate of 10% instead of its incremental borrowing rate of 11% because it's lower and it knows about it. So Sterling records the capital lease on his books on January 1st, 2017 as leased equipment for $100,000, a debit, and a credit to the lease liability for $100,000. Sterling records the first lease payment on January 1st, 2017 as follows. Property tax expense for $2,000 is debited. The lease liability again was $23,981.62, and then it's a credit to cash for $25,981.62. So here you have an illustration of the lease amortization schedule for Sterling Company. And you can see the $23,000 was the first entry because for the liability, because there is no interest in the first year. And so going over this table, so you have your date, your annual lease payment, your executory costs, interest on liability, reduction of lease liability, and lease liability. And so the lease payment as required by LEASING. So that was already broken out for us. The costs included in rental payment, the $2,000, 10% of the preceding balance, except for the beginning of the year, has elapsed the date of the first payment and no interest has occurred. So C, that's what's giving you for C. And then D is A minus B and C. So it's $25,981.62 minus the $2,000. And then E is the preceding balance minus D. So E, you're going to reduce it by the principal payment, and you come up with a $76,000. And so each year is treated accordingly. So prepare the entry to record accrued interest at December 31st, 2017. So interest expense is $7,601.84 debit, and you're going to credit interest payable for $7,601.84. And this is coming directly from the table right here. Prepare to require December 31st, 2017 to record depreciation for the year using the straight line method. So that's $100,000 divided by 5 years. So the depreciation expense for capital lease is $20,000, and the accumulated depreciation credit for capital lease is $20,000. The liabilities section as it relates to lease transactions at December 31st, and here to just give you an illustration of current liabilities and the non-current liabilities. So Sterling records a lease payment on January 1st, 2018 as follows. And so property tax is $2,000 debit. Interest payable, $7,601.84. Remember, you credited at the end of December for an accrual, so now you're actually paying it. Lease liability was $16,379.78. And so that's a credit to cash for $25,981.62. And so this information, once you've created this schedule, this information is coming directly from the schedule for the year. Operating method. The lessee assigns rent to the periods benefiting operating method for operating leases. The lessee assigns rent to the periods benefiting from the use of the asset and ignores in the accounting any commitments to make future payments. Assume Sterling accounts for the lease as an operating lease. Sterling records the payment on January 1st, 2017 as follows. A debits a rent expense for the total $25,981.62, and a credit to cash for $25,981.62. No other entry is required. So here you have schedule of charges to operations, and they're going to give you a capital lease versus an operating lease. And so you kind of can see the differences. The information that's captured under a capital lease, and then the operating lease would just be the $25,000 for every year until you pay the full lease. And so differences using a capital lease instead of an operating lease: you have an increased amount of reported debt, an increased amount of total assets, and lower income early in the life of the lease. So that's the end of the key points. And so the quiz at the end of this chapter is going to require a password. The first letter for that password is L. There's 4 more letters, and you can acquire them by watching the brief exercises that'll be posted for this chapter. Thank you.